Hello and a warm welcome from Frankfurt. Welcome back to our primary markets update for the quarter. This time is for the third quarter. My name is Thomas Kors. I run the financial institutions business at Helaba, and today I have Alexander Kirsch from our syndicate desk here with me.
Thank you, Thomas. Hi.
Matthias Mems is on holiday, well deserved, because the biggest gig in the ECBC market, in the covered bond market, just finished the big ECBC conference in Porto. That's over now, and with it also the longest summer break I seem to remember. However, the overall market is now in interesting shape. We have a big difference in the behavior of the primary markets, apparently, and the secondaries. The primaries seem to be on fire all the time, but then there are also a record number of no deals, so nothing comes out of the primary market at all, followed again by markets being on fire. So it's a bit of up and down, whipsaw markets. Secondaries, however, are a bit more constant in their lack of turnover, and if there's turnover, we seem to see a lot more bids being hit than actually offers being lifted. So there may be something building up in trading books here. We have to watch that. We still see fully sold order books, but at the same time, we don't see them actually performing in the aftermarket. A warning sign that we should keep in mind. We said last time, best time in the market to issue credit. Everything seems to be risk on, and credits appear to be somewhat expensive. Best time to buy rates, however, at the elevated levels, because the performance there has been, until very recently, pretty stable, especially so for covers. Year-to-date volume is pretty good for the overall market, 50% more than last year round at about 1.4 trillion euros. But that's driven by SSA issues, mostly by the euro names, and to a lesser degree also by credit, mostly S&P. Covers are a little bit behind the curve in terms of overall issuance activity, but we'll hear Alex to explain a bit more in detail why that may be the case and what to expect. So Alex, let's look at the primary markets and covers to start with.
Yeah, thank you very much, Thomas. I brought 4 slides regarding the volume we have seen since January. We started very strong in the covered bond market, but as you can see, there was a long break in the summertime, driven by the elections we have seen in the EU, but also in France. And because of this, there was almost 1 month with very, very low supply.
Yeah, almost nothing, absolutely. But that was just covered, right?
This was just covered, exactly.
Okay, what about the credit markets?
On the senior preferred market, as you can see, we started extremely strong in January. But also here we see that the summer break also slowed the issuing process of a lot of issues.
And we're still behind last year, right?
We are still behind last year, but I'm pretty confident that we will be a little bit higher than 2022.
Okay, senior non-pref?
Senior non-pref,
GCS stuff?
I would say this was the most demanded asset class by investors. We have seen that we are still in the risk-on modus. We see that investors are looking for yield and spread. And as you can see, we are on a record level year-to-date on senior non-preferreds.
Okay, so that's the only financial asset class that actually outperformed last year in terms of total issues, right?
Yeah, that's true, okay. Absolutely.
Now you got SSAs up.
Yeah, SSA, also a very strong start in the first quarter. And this graph is mainly driven also by EU names, you know, from the European Union, EIB, etc., etc. So we are still close to record levels, but I think we will close slightly below 2023.
Okay, well, from what I hear, actually, that's the one thing driving actually spread widening at the moment, the flood of SSA issues, especially from the EU names. But we get to that a little bit later, yeah. I think. So let's talk about the dynamics in these individual sectors. You have analyzed a little bit more what happened in the covers. Let's talk about that. What's the big story here?
The big story on the covered bond market is what you can see if you compare the first 9 months of 23 with year-to-date in 24, that there was a shift from shorter tenors to longer tenors. Last year, the main demand was in 3 and 5 years, and this year it's from 5 to 7. And very interesting to see is that the 10-year bucket to 10 years plus almost doubled from 15 billion to 30 billion.
Feels a bit counterintuitive, because if I recall the last few weeks of issuance, only the shorter stuff really went well, and the longer stuff did fight a little bit. Also, there hasn't been that much in long issuance. But anyway, look at the individual factors that drive this. If I look at that chart of yours here, seems to be that all indicators for covers have sort of worsened, with the exception of ESG. Let's talk about that a little bit.
Yeah, what you can see, Thomas, is absolutely right. We started with a huge new issue premium on average of 4 basis points in January, or let's say in the fourth quarter. We have seen a lot of flows, a lot of supply, so the new issue premium tightened in by 3 basis points to close to 1 point. But after the long summer break, issuers had to pay up a little bit to tap the market so that the new issue premium went up again to closely a little bit higher than 2 basis points.
And that also explains why book sizes have fallen and cover ratios, I suppose.
Yeah, the book size reduction is mainly driven by the very flat interest rate curve, essentially the swap market. So there was more demand for the shorter end than for the longer end from investor side.
Well, the nice green spot is that more ESG issuance as in the past.
Yeah,
that's also a very
as a positive
point.
effect. Absolutely.
And it rarely happens in covered so far. Let's look at the credit side. So senior pref, mixed bag, huh? Tenors books a nit better, but the other factors seem to be worse.
Yeah, it's similar, but also different, especially on the tenor side. The maturities increased slightly on the senior preferred side, as you can see with the bottom in Q2. The book size increased again after the summer break, so this shows us there is a risk-on modus still going on, and there was a preference for preferred over covereds.
And senior non-pref?
Senior non-pref, as you can see, most of the arrows are green. So this is, as I mentioned, it was the preferred asset class over the first 9 months. The tenor was longer dated, and if you see the columns on the left-hand side, you see that the issue volume in 10 years almost tripled from 7 billion to more than 20 billion in comparison to last year.
Well, as you said, that seems to mirror what you said before, that senior prefs are sort of halfway in between senior non-prefs and covers,
yeah.
And your indicators seem to mirror exactly that.
Yeah.
Now, if we look at the issuance by country, hasn't been that much of a surprise. Basically, France has dominated the first quarter, together with Germany number 2, then followed by Austria, Canada, and Italy. If you look at the combined bars here for the whole year, the first two are still the same. France, which also explains why there is a little bit of pressure on the spreads here. Germany, and then followed by Canada already at number 3. Actually, mainly driven by one issuer that issued almost 10 billion this year. That's probably an exception, but we'll see. Maybe they come back with these sizes. So, but that all had an effect on spreads. And to that, I'd like to draw the attention now to the following chart, where Alex is going to give us a little bit more of interpretive hints.
Thank you. Yeah, what do we see here? We see on the bottom the iBox index from sovereigns, from agencies. Then you see it from covereds, and on the top you see it from senior preferred and non-preferred. And what is interesting to recognize is that on the credit side, we have seen a tightening from January to now by 18 to 22 basis points. So the spreads are tightened in significantly.
That's from the 27 to the 12? Or?
No, this is actually the.
Oh, sorry, wrong chart.
This is the chart on the top. On the bottom, if you look at the sovereign curve, but also at the agency curve, you see there had been a widening of close to 20 basis points. And the covered bond market, if you're looking for low volatile products, I think you can see that the covered bond market was the product with less volatility involved.
As you said before, best time to buy covers was a quarter ago.
Absolutely, but interesting to see is, if you can see it, is here. This is the iBox index for agencies, and this is for covered bonds. The big question will be, does the tightening of the spread, which was in the beginning of the year 27 basis points between agencies and covereds, it's now 12 basis points between agencies and covereds. What will happen over the next months? Is there a risk or a chance that covered bonds are pricing through agencies or not?
If I think about the still pending issuance need by the EU, I have a pretty clear view on that. But let's look at the outlook then. What are, in your view, the volatility drivers for the rest of the year?
The volatility drivers, Thomas, are honestly quite similar to our last update.
Same but different?
Yeah, we have still 2 wars going on, unfortunately, so hopefully they will be finished at an early point. But this is always a risk of events.
Probably
we have to be
too. Yeah.
Absolutely. Then we have the central bank policies, ECB and Fed, in the main focus. What's happening on the next meetings? Will there be a cut of 25 or 50 basis points? You have inflation data and labor market data. These are very important measurements from the central banks to decide on cuts or not. And finally, the US elections, which take place beginning of November.
Has become a bit more interesting now with Harris instead of Biden.
Yeah, will it be a non-event or not? We will see. But everybody wants to be more or less done with their funding needs before this date.
So what you're saying is we expect a lot more issuance before the election, and then probably everything stopping.
Yes, this could be, but there will be a 2 to 3 weeks window, I would say, end of November. So if the elections are okayish, I would say there will be a short window for latecomers, but most of the issuers, I'm pretty sure they want to be issued before the date.
So let's hope no more runs on the White House.
Yeah.
With this in mind, we're finishing. Thank you very much for bearing with us. Thank you for watching our primary market update. I'm Thomas Kors. This is Alexander Kirsch. We're from Hellerbar. This was our regular update. Give you the next one in about 3 months. Thank you very much for watching. Take care.
Bye-bye.